The 3rd of November 1907, Sunday evening, New York City. The financial panic had been raging for 2 weeks. Banks were failing. Trust companies were collapsing. People were lining up overnight to withdraw their money. The stock market had crashed. Unemployment was spiking. And the United States had no central bank, no lender of last resort, no institution that could stop the bleeding. So the job fell to one man, John Pierpont Morgan, the most powerful banker in America, and he summoned them to his library. Around 8 p.m., trust company presidents began arriving at Morgan's brownstone mansion on Madison Avenue and 36th Street. 40 to 50 bankers, the most powerful men in New York finance. They gathered in the library, a magnificent room, floor-to-ceiling bookshelves, Renaissance paintings, a Gutenberg Bible. And at midnight, after hours of negotiations were going nowhere, J.P. Morgan did something extraordinary. He locked the doors from the outside and pocketed the key. The bankers were trapped inside the library, and Morgan told them they weren't leaving until they solved the crisis. He needed $25 million to bail out the failing trust companies, to prevent a complete collapse of the banking system. The trust company executives were reluctant. They didn't want to risk their own money, but Morgan made it clear. Either they agreed, or the entire system would collapse in the morning. At 3 a.m., exhausted and desperate, they agreed. Morgan unlocked the doors. The bankers pledged $25 million, and the panic of 1,907 ended. But Morgan realized something that night. America couldn't rely on one man to save the economy. Next time, he might not be there, or he might not have enough money, or Congress might not let him act. So 3 years later, in November 1910, Morgan arranged a secret meeting at a private club on Jekyll Island, Georgia. 6 men, 1 week. And they wrote the blueprint for the Federal Reserve, the central bank that would replace J.P. Morgan and institutionalize his power forever. Let me show you who J.P. Morgan was, because his power is almost incomprehensible today. John Pierpont Morgan, born 1837, son of a banker, grandson of a banker. Banking was in his blood. In the 1,870 seconds, he began consolidating industries, railroads first, then steel, then electricity, then banking. His method was simple: find competing companies, force them to merge, eliminate competition, create monopolies, and take a cut of everything. By 1900, J.P. Morgan controlled more wealth than the U.S. government. In 1895, the U.S. Treasury ran out of gold. The country was on the gold standard. Without gold reserves, the dollar would collapse. President Grover Cleveland had no solution, so he turned to J.P. Morgan. Morgan organized a syndicate of bankers. They loaned the U.S. government $65 million in gold in exchange for bonds. The deal saved the dollar, but it also revealed something terrifying. The most powerful nation on earth was dependent on one private banker, and Morgan knew it. By 1907, Morgan was 70 years old, mostly retired, spending his days in his library, collecting art, reading, away from Wall Street. But when the panic hit in October 1907, everyone turned to him, because there was no one else. The panic started with a failed speculation. 2 brothers, Otto and Augustus Heinze, tried to corner the market on United Copper stock. They borrowed millions, bought up shares, planned to squeeze short sellers. But the scheme collapsed. The stock crashed. The Heinze brothers were ruined. And the banks that lent them money faced massive losses. One of those banks was the Knickerbocker Trust Company, the 3rd largest trust in New York. When news spread that Knickerbocker was exposed to the Heinze losses, depositors panicked. On the 22nd of October 1907, a run began. Depositors lined up outside Knickerbocker's headquarters, demanding their money. By noon, the bank had paid out $8 million. By 3 p.m., it was out of cash. Knickerbocker closed its doors. Its president, Charles Barney, was forced to resign. 3 weeks later, he shot himself. The panic spread. If Knickerbocker could fail, any bank could fail. Runs began on other trusts. The Trust Company of America, the Lincoln Trust. Both faced collapse. The stock market crashed. Trading volume dried up. Brokerages couldn't settle trades. They needed cash, but banks refused to lend. Credit froze. Businesses couldn't get loans. They laid off workers, unemployment spiked, the economy was in free fall, and there was no government institution to stop it, no Federal Reserve, no FDIC, no lender of last resort, just J.P. Morgan. Now, let me show you how Morgan stopped the panic, because this is the blueprint for central banking. Morgan returned to New York from a church convention in Richmond, Virginia, on Saturday night, October 19. By Sunday morning, his library had become command central. Bank presidents arrived one by one, sharing information, seeking help. Morgan examined the books. He had teams of young financial experts, including Benjamin Strong, who would later become the first head of the Federal Reserve Bank of New York. They evaluated which institutions could be saved and which were insolvent. Knickerbocker Trust. Morgan looked at the books. Insolvent. Let it fail. But other institutions, the Trust Company of America, the Lincoln Trust, these could be saved if they got emergency liquidity. So Morgan organized a bailout. He called Treasury Secretary George Cortelyou, convinced him to deposit U.S. government funds into New York banks. $25 million from the Treasury. Then Morgan rallied the private banks. He and his allies, James Stillman of National City Bank and George Baker of First National Bank, pooled their resources. They created a consortium, an ad hoc lender of last resort. They channeled money from strong banks to weak ones, keeping the system afloat. On Thursday, October 24, another crisis hit. The New York Stock Exchange was about to close early, because brokerage firms couldn't settle their trades. They needed $25 million in loans, immediately, or the market would collapse. Morgan summoned the bank presidents to his office, told them they had 10 minutes to pledge the money. They did. The stock market stayed open. By early November, the panic was subsiding. But the trust companies were still fragile. They needed a permanent solution. That's when Morgan locked the bankers in his library. On Saturday night, November 2, Morgan held separate meetings. The bank presidents in the East Room, the trust company executives in the West Room. Morgan and his team moved between them, negotiating, cajoling. At midnight, Morgan made his ultimatum. He would help shore up the brokerage firm Moore and Schley, which was about to fail. But only if the trust companies agreed to bail out their weakest institutions. The trust executives resisted. It would cost them $25 million. That's when Morgan locked the doors. The bankers realized they were trapped. At 3 a.m., Morgan entered the room where the trust presidents were gathered. He laid out the terms. $25 million. No negotiation. One of Morgan's associates later recalled Morgan saying, "If you don't do it, everything will collapse in the morning." The trust presidents signed. Morgan unlocked the doors at 4:45 a.m. The crisis was over, but the political fallout was just beginning. Let me show you the aftermath, because Morgan's rescue created as many problems as it solved. The panic of 1907 exposed a fundamental weakness in the American financial system. The country had no central bank. In Europe, countries like England, France, and Germany had central banks. Institutions that could provide liquidity in a crisis, act as lenders of last resort. But America had abolished its central banks twice, once in 1811, again in 1836. Andrew Jackson famously said he would kill the second bank of the United States, and he did. By 1907, the U.S. had been without a central bank for 71 years, and the result was periodic panics. 1,873, 1,893, 1,907. Each time, private bankers like Morgan had to step in. But what happens when the private bankers can't or won't act? What happens when the panic is too big? What happens when Morgan is dead? These were the questions Congress asked. In 1908, Congress passed the Aldrich-Vreeland Act. It created the National Monetary Commission to study banking reform, to propose solutions. Senator Nelson Aldrich was appointed chairman. Aldrich was the Republican leader of the Senate, chairman of the Senate Finance Committee, and, importantly, related to the Rockefeller family by marriage. His daughter married John D. Rockefeller, Jr. Aldrich spent 2 years studying European central banks, traveling to London, Paris, Berlin, meeting with central bankers, learning how their systems worked. By 1910, Aldrich was convinced America needed a central bank. But there was a problem. The American public hated central banks. They associated central banking with concentrated power, with European aristocracy, with the money trust. If Aldrich proposed a straightforward central bank, Congress would reject it. The public would revolt. So Aldrich needed a different approach. He needed a plan that looked decentralized but functioned as a central bank. And he needed bankers to help him design it, but he couldn't do it publicly. If the public knew Wall Street bankers were writing the legislation, it would be dead on arrival. So Aldrich organized a secret meeting. November 1910, Jekyll Island, Georgia. Now let me show you the Jekyll Island meeting because this is where the Federal Reserve was born. Jekyll Island was a private resort off the coast of Georgia. Founded in 1886, members included the wealthiest men in America: J.P. Morgan, William Rockefeller, William Kissam, Vanderbilt, Marshall Field. The club was described in 1904 as the richest, the most exclusive, the most inaccessible club in the world. In November 1910, Senator Aldrich arranged to use the club's facilities, probably through J.P. Morgan, who was a member. Aldrich invited 6 men: Senator Nelson Aldrich, his private secretary Arthur Shelton, A. Piatt Andrew, Assistant Secretary of the Treasury, former Harvard economics professor Henry Davison, senior partner at J.P. Morgan, Frank Vanderlip, president of National City Bank, the predecessor to Citigroup, Benjamin Strong, vice president of Bankers Trust, later the first head of the New York Fed, and Paul Warburg, a partner at Kuhn, Loeb & Co., a German immigrant. An expert on European central banking, Warburg was the intellectual architect of the plan. To keep the meeting secret, Aldrich created an elaborate cover story, a duck hunting trip. The men were instructed to come one at a time to a train terminal in Hoboken, New Jersey. There they boarded Aldrich's private rail car. Attached to the back of a southbound train, to prevent the staff from recognizing them, the men used only first names: Nelson, Harry, Frank, Paul, Piatt, Arthur. For years afterward, they called themselves the First Name Club. The train arrived in Brunswick, Georgia. From there, they took a boat to Jekyll Island. They spent 9 days at the club, November 22 to the 30th of November 1910, working in secret, drafting legislation. The goal was to create a central bank, but they couldn't call it that. So Warburg proposed a different name: the Federal Reserve System. The word reserve sounded safe. Banking reserves, not a central bank. And Warburg proposed a structure that looked decentralized. Multiple regional reserve banks, 12 of them, spread across the country. In cities like New York, Chicago, Dallas, Richmond, San Francisco, each regional bank would be governed by local bankers. It would look like the system was controlled by regional interests, but in reality, power would be centralized. In New York, where the money was, where Morgan and his allies controlled the banks. The regional structure was camouflage, a political necessity. Warburg later wrote, "I like your ideas. I have only one fault to find with them. You say that we cannot have a central bank, and I say we can." But Warburg was more realistic. He knew the American public wouldn't accept a European-style central bank. So the deception was necessary. By the end of the week, the group had drafted the Aldrich Plan, the blueprint for the Federal Reserve. They returned to New York, and Aldrich presented the plan to Congress in January 1911. He never mentioned Jekyll Island, never revealed that bankers had written the legislation. But the secret couldn't last forever. Let me show you how the Federal Reserve was created, because it took 3 more years and a change in administration. The Aldrich Plan faced immediate opposition. Democrats controlled the House. They opposed anything associated with Aldrich, a Republican, and they opposed anything that looked like it benefited Wall Street. So the Aldrich Plan stalled. Then, in 1912, the political landscape shifted. Woodrow Wilson was elected president. Democrats won control of both the House and the Senate. The Aldrich Plan was dead, but the idea wasn't. Congressman Carter Glass of Virginia and Senator Robert Owen of Oklahoma took the lead. They drafted a new bill, the Glass-Owen Bill. It was nearly identical to the Aldrich Plan. The same structure, 12 regional reserve banks, a board in Washington, but with a few changes to make it politically acceptable. The Federal Reserve Board would be appointed by the president, not by bankers. This gave the appearance of government control. But in practice, the bankers still had enormous influence. Because the regional reserve banks were owned by private banks, the member banks elected 6 of the 9 directors of each regional bank. The other 3 were appointed by the Federal Reserve Board. So the system was a hybrid, nominally public, actually private, which was exactly what the bankers wanted. In December 1913, Congress passed the Federal Reserve Act. President Wilson signed it on the 23rd of December 1913. The Federal Reserve System was created, and the secret of Jekyll Island remained hidden for 20 years. It wasn't until the 1,930 seconds when books were published about the founding of the Fed that the truth came out. By then, it was too late. The Federal Reserve was entrenched, irreversible, and J.P. Morgan had successfully replaced himself with an institution. Now let me show you the Pujo Committee hearings because they exposed just how much power Morgan had accumulated. In 1912, while the Federal Reserve legislation was being debated, Congress launched another investigation. The Pujo Committee, named after Congressman Arsène Pujo of Louisiana, the goal was to investigate the money trust, the concentration of financial power in the hands of a few bankers. The committee's lead investigator was Samuel Untermeyer, a progressive lawyer, and their target was J.P. Morgan. The hearings began in May 1912. They lasted 9 months. Witnesses included the most powerful bankers in America. Morgan himself testified in December 1912. The committee presented devastating evidence. Through 341 directorships held by Morgan and his allies, they controlled 112 corporations, with aggregate resources of $22.5 billion. To put that in perspective, the entire New York Stock Exchange was valued at $26.5 billion at the time. Morgan and his circle controlled 85% of the market. The corporations included 34 banks and trust companies, with $2.7 billion in resources, 10 insurance companies, with $2.3 billion in assets, 32 transportation systems, railroads, steamship lines, express companies, with $11.8 billion in capitalization, 24 industrial corporations, with $3.3 billion in capitalization, 12 public utility corporations, with $2.2 billion in capitalization. This was the money trust, a small group of men. Morgan, George F. Baker of First National Bank, James Stillman of National City Bank. Together, through interlocking directorates, they controlled the American economy. But Morgan's testimony was stunning, not because he admitted wrongdoing, but because he denied the obvious. Untermeyer asked Morgan, "If you owned all the banks in New York, with all their resources, would you not come pretty near having a control of credit?" Morgan replied, "No, sir, not at all." Untermeyer pressed, "But assuming you had all the money, you would have it, would you not?" Morgan, "No, sir." This exchange became famous because it revealed Morgan's worldview. He didn't believe power came from money. He believed it came from character, from trust, from relationships. When asked what the basis of credit was, Morgan said, "The first thing is character." Untermeyer, "Before money or property?" Morgan, "Before money or anything else. Money cannot buy it." This was either profound or delusional. Because Morgan's character was inseparable from his wealth, the committee's report was scathing. It concluded, "There is an established and well-defined identity and community of interest between a few leaders of finance, which has resulted in great and rapidly growing concentration of the control of money and credit in the hands of these few men." The findings led to 3 major pieces of legislation. The Federal Reserve Act of 1913, to create a lender of last resort. The Clayton Antitrust Act of 1914, to ban interlocking directorates. The Federal Trade Commission Act of 1914, to regulate monopolies. But by the time these laws passed, Morgan was dead. Let me show you Morgan's death because the timing was suspicious. J.P. Morgan died on the 31st of March 1913, 4 months after testifying before the Pujo Committee. He was 75 years old. The official cause of death was heart failure and complications from a stroke. But many believed the stress of the Pujo hearings killed him. His daughter Louisa said he was never the same after the testimony. The humiliation, the public scrutiny, the revelation of his power, it broke him. When Morgan's will was published, it revealed something shocking. His net worth was $80 million in 1913 dollars, about $2.4 billion today. This seems like a lot, but it was far less than people expected. John D. Rockefeller, for comparison, was worth $900 million. Andrew Carnegie had sold his steel company for $480 million in 1901. Morgan, the most powerful banker in America, was worth a fraction of the industrialists he financed. Why? Because Morgan didn't accumulate wealth. He accumulated power. He made money by controlling other people's money, by sitting on boards, by arranging mergers, by taking fees. When Morgan died, the New York Stock Exchange closed for the day. The first time it had ever closed for an individual, flags were lowered to half-staff, tributes poured in from around the world. Lord Rothschild sent a message of admiration and respect. But the progressive press was less kind. They called him a robber baron, a monopolist, a symbol of concentrated wealth. Louis Brandeis, who would later become a Supreme Court justice, wrote a book titled Other People's Money and How the Bankers Use It. It was a direct attack on Morgan and the money trust. Published in 1914, Brandeis argued that the concentration of financial power was a threat to democracy, that bankers like Morgan controlled too much, and that the public needed protection. The book became a bestseller, and it shaped the regulatory reforms of the progressive era. But by then, Morgan's legacy was secure. The Federal Reserve was created. The system Morgan designed to replace himself was operational, and it would last for the next 111 years and counting. Let me end with the irony, because Morgan saved the system and then institutionalized his power. In 1907, J.P. Morgan was a hero. He stopped the panic, saved the banks, prevented a depression. Using his own money and his own influence, the public praised him. Congress thanked him. Even his critics admitted he was indispensable. But that heroism was also a problem, because it revealed that the entire American economy depended on one man, a private citizen, with no accountability. What if Morgan had refused to help? What if he had been out of the country? What if he had died in 1906? The system would have collapsed. So Morgan, in a moment of rare selflessness or strategic brilliance, created the Federal Reserve, an institution to replace him, to do what he did in 1907, but permanently, and with government backing. The Federal Reserve would be the lender of last resort. It would provide liquidity in crises. It would stabilize the banking system. It would do everything Morgan did, except it would never die. And it would have infinite resources, because it could print money. But here's the irony. The Federal Reserve didn't eliminate the power of bankers like Morgan. It institutionalized it. The regional reserve banks were owned by private banks. The boards were controlled by bankers. The New York Fed, the most powerful of the 12, was run by Benjamin Strong, Morgan's protege, from 1914 to 1928. So, in effect, the Federal Reserve was J.P. Morgan in institutional form, his power, his methods, his control, all codified into law, protected by the government, and made permanent. Today, the Federal Reserve is the most powerful financial institution in the world. It controls the money supply, sets interest rates, regulates banks, bails out failing institutions. And it does all of this with minimal oversight. Congress can't audit it. The president can't fire its chairman mid-term. It operates independently, just like J.P. Morgan did in 1907, from his library, with the doors locked, making decisions that affect the entire economy. Except now, it's not one man. It's an institution, and institutions don't die. They endure forever. Hunk of the economy wit.